Welcome to Deloitte's Debriefs Tax webcast series in Asia Pacific. Our webcast today is from our Indirect Tax series and is titled Digital Trade in Singapore and Malaysia, Implementation and Moving Forward. My name is Richard McKender and I'm a tax partner based in Deloitte, Singapore. I have the pleasure of hosting today's webcast, which incidentally is also going to cover off Vietnam. I have two speakers with me today, Sen Elalingam and An Vo Hiep Van. Sen is a tax partner based in Deloitte, Malaysia, and is a tax partner based in Deloitte in Vietnam. You can access our bios to the left of your screen. Before I go through the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. Firstly, users are on listen-only mode. If you have content-related questions, you can submit those at any time in the Q&A box at the bottom right of your screen. We'll do our best to respond to your questions during the presentation. Secondly, all PC users can maximize or minimize the boxes on the screen at your convenience during the webcast. You can also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, you can go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the surveys on screen. In addition, if you want attendance record for this event, you'll receive an automated email with a CPE certificate after watching for 50 minutes, so you have to hang around for a while. Without further ado, let's switch over to the agenda for today's session. As I mentioned, and this is a session to explore what's going on with indirect taxes and the digital economy, in particular Vietnam, Singapore, Malaysia. So first of all, we'll just set some scene and a bit of background. We'll run through the OECD's guidelines for the digital economy and get a sense of what the OECD thinks. And that gives us a framework to compare and contrast what in particular these three jurisdictions have done. Then we're going to focus on the digital services tax regime, which is being introduced into Vietnam, and Anne is going to run through that for us. Then we'll spend a little bit of time looking at what Singapore has been doing with its expanding overseas vendor registration rules. And then finally, we'll hear from Sen on the sales tax on low-value goods. And we'll have time for questions and answers as well. So without further ado, let me hand over to Sen and ask Sen to elaborate a little bit on what the OECD is up to.
Okay, thanks, Richard. Hi, everyone. Yes, so before we actually get into the challenges under the current model, I think in terms of why the OECD's released a toolkit and what purpose it serves. Firstly, I think over the last sort of 5-10 years, the OECD has released a lot of guidelines in conjunction with the changes that have been made as a result of BEPS. There are significant sort of recommendations that were made as part of that around taxing the digital economy. Now, what the VAT Digital Toolkit for the Asia Pac does is sort of bring all of that into one sort of comprehensive document, and it's been tailored towards supporting Asia Pac governments and tax authorities around implementing rules to tax e-commerce. And in particular, the OECD uses website is pretty much designed this toolkit to help governments secure increased VAT revenues and ensure a level playing field between the traditional bricks and mortar businesses and foreign online merchants. It is a very detailed document. We're talking about over 250 pages. And it covers everything from key implementation and operational aspects of VAT reform, policy, design and legislative reform, building the infrastructure to support businesses to bring them into the system, the requirements around setting requirements around registration, compliance, even things like how the government should do an effective communication strategy, and what approaches and methods that they can take to tackle VAT fraud within online trade as well. And a lot of this has come about after significant consultation with various AP governments and various AP tax authorities. So it's certainly something that they've been working on for quite some time. And this is not only something that they're doing for Asia Pac, it is actually a part of a series where they've already released one in partnership with the World Bank for Latin America and the Caribbean. And they're expecting to release one for Africa very soon as well. So then if we move on to the next slide around, sorry, actually, we can jump back a slide, apologies. So around the deficiencies that we are seeking to address. So in terms of the current deficiencies in the indirect tax laws, what we are looking at really is that the traditional indirect tax laws have been structured around a more traditional sales model where you have companies or businesses that are established in the same location where the consumer or the customer who's acquiring those goods or services are. What we've seen over the recent years, but certainly over the last decade, but it's certainly taken off in the last few years with COVID, is you've got a lot of sellers who are now no longer, or service providers who are now no longer located in the same jurisdiction where the customer is. And so the laws that we have currently are not equipped to tax those services, especially in a B2C scenario, business to consumer scenario, where the non-resident service provider is providing services to resident customers because they are not obligated to account for tax under, say, a reverse charge. The other area where there's a significant deficiency is around what we call low-value goods. So in most AP jurisdictions, there is a threshold where if goods are imported at a value below that particular threshold, tax is not collected because it's simply not cost effective to do so. And that's been in place for quite some time. However, again, that threshold did not anticipate the significant volume that we have now of such types of goods that are being delivered, whether through directly from foreign sellers or via platforms and marketplaces. And so the increase in the level of digital trade has meant that there's a significant amount of tax that is not being collected and falling through the net. And so this creates this uneven playing field between local retailers and foreign service providers. And so not only from a consumer perspective, it creates more of an incentive for people to purchase from these foreign providers. There is also a significant loss in terms of revenue to treasuries and tax authorities arising from that. So if we move on to then the core recommendations around what the OECD has recommended. So one of the initial recommendations is really around establishing the legal framework which would allow for the foreign service providers or foreign entities which don't have an establishment in that country of where the customer is located to be able to be brought into the net. Traditionally, under GST and VAT models, if you didn't have an establishment in a particular country, you did not have an ability to register or collect tax, and that's one of the critical changes that they've proposed as part of the toolkit. Then they've also talked about establishing a set of criteria principles for determining where a particular customer is located. So traditional GST VAT rules look at consumption, where consumption occurs. That this one is sort of setting more granular principles around looking at the address, billing address, IP address, bank card payment information. Then looking at implementing a vendor collection model where it becomes the vendor's obligation to collect and register and collect the tax. Whereas traditionally we've had reverse charge models where foreign entities outside of the system, outside of the jurisdiction, it's always on the local service or recipient to account for the tax, and that's a significant shift there as well. Where there's intermediaries like platforms and marketplaces, to look to shift the obligation for collection onto those platforms and marketplaces. Finally, and a very critical thing around remote services is providing a more simplistic and easy avenue to comply, and this is things like providing a much more simplified online registration, relaxing reporting requirements, invoicing requirements, and generally just making it very easy for them to enter into the net. If we go to the next slide around low value goods, the principles there that we're looking at really is around imposing the requirement to collect tax on the foreign seller or the platform at the point of sale rather than on the customer at the point of import. Applying a simplified registration and invoicing method, including requiring platforms to collect tax. So, and finally, ensuring that there's greater consistency across jurisdictions in terms of how the rules have been implemented. Now, the table that you currently see on your slide, which is essentially gives a snapshot of the current implementation of remote services rules. So you'll see some consistency across the jurisdictions, with a few minor exceptions where you see like Malaysia, which has B2C and B2B, for example. But generally speaking, the OECD principles have been followed. An interesting thing to note there is that Singapore, Australia, and New Zealand have adopted the wider interpretation of remote services to include more than just traditionally the electronically supplied services. So you've got things like accountancy and consultancy that could be taxed. This broader definition of remote services is also what we see in the OECD toolkit, and that terminology is used rather than, say, electronic or digital services. On my final slide, the next slide, for low value goods, so far there hasn't been as wide an adoption yet. So we've seen Australia and New Zealand implemented. Singapore, which Richard will touch on, has proposed to go live 1 January 2023, and likewise Malaysia is also looking to follow suit around the same days. With that, back to you, Richard.
Thanks, Sen. I appreciate the overview there. Sounds like the OECD has been very busy, and interesting that they're doing it on a regional basis. I think now is a good time for us to do a quick polling question, which we always like to do, just to help with making sure you guys are all awake out there. So first, and it's a very simple question: have you been impacted, or has your business rather been impacted by the digital services rules in the region? 3 answers for you. Yes, we have a number of registrations in the region. Potentially, I need to learn more, hence one of the reasons why I'm listening in today. Or not as far as we are aware, but you never know where the rules might take us. So while you are contemplating which is the appropriate answer for you, then Sen, maybe just coming back to that OECD point, a number of the jurisdictions have not gone as far as the OECD said, and you pointed out that a couple of the jurisdictions have with remote services. What's your take on what's going to happen more broadly in the region around adoption of this OECD recommendations? Are we likely to see continuing and widening kind of scope of digital services rules?
Mm-hmm. Yeah, I expect so. I think Australia and New Zealand were really some of the early adopters, and so to see them then adopt the low value goods, for example, after electronic services, and then having that remote services sort of broader interpretation. Similarly, I think with Singapore as well. I think with countries like Thailand and Vietnam, we're just seeing more recent implementation, so they might wait a little to bed those down before they expand the scope. But I expect that once they sort of see the adoption in these countries, that they'll be we'll see more countries in AP sort of expand around low value goods, but also on remote services, because there is obviously money on the table there. Yeah, exactly. That, I mean, I would kind of expand on that and figure, as we hear from Anne shortly, that one of the things we're probably going to see in this hunt for revenue that's going to be coming in the next 12-18 months is more of a focus on where the easy pickings are, and e-commerce is an easy way to expand out the scope and address changing consumer patterns and so on. So I would tend to agree with you. I'm sure we're going to see more of this regime growing and expanding. Okay, I don't know whether we can get to see the polling results. Let me have a look, see whether those are up yet. One second, I don't know whether I can see those. Yeah, I can see them, Richard. I think we've got.
Here we go. Yeah. Good. Okay. Yep, they just popped up. All right. So thank you for those of you that responded. About a quarter of you are already impacted and are going through registrations in the region, and we feel your pain. Potentially, then a bunch of you, 43% of you, are saying could well be and let me learn more. So thank you for joining, and I hope that we can elaborate a little bit on the impact, particularly Southeast Asia, and either set your mind at rest or at least trigger you to go and get yourselves compliant. And about a third of you are saying not as far as we're aware, but you can never can tell. And I think that comes back to the point we were just talking about, which is these rules are not static, and it's likely that as tax authorities wise up to the opportunities, that those rules will be broadened. So I think it's very wise that you keep up to date with what's going on, and make sure that you're not falling into a compliance trap that you missed. So thank you very much. I think let's move on. Anne, can you go through what's happening in Vietnam with their digital services tax rules?
Yes, thanks, Richard. Hi, everyone. This is Anne from Vietnam. And let me walk you through the new digital service tax rule in Vietnam. First introduced in July 1st, 2020 under the law on tax management in Vietnam, and went into effect on 1st January 2022 under the release of the Circular 80 in late 2021. The DST rule in Vietnam is applicable to offshore suppliers doing e-commerce, digital business, and other service through both B2B and B2C transactions with customers in Vietnam. This is actually not a new tax law in Vietnam. It's just a new tax filing mechanism focused on offshore suppliers who doing e-commerce and digital service into Vietnam. In fact, although the circular has been released in January 2022, the new mechanism is only put into operation since 21st 2022, when the Central Tax Department held a press conference to announce the official launch of the portal for offshore suppliers to register, declare, and pay tax in Vietnam. And you can see in the bottom of this slide is the link to that portal where you can access and register to pay tax in Vietnam if applicable. And that will move us to the second slide, where I will walk you through what is the DST rule in Vietnam cover about. So there are, first of all, discussion about the method of tax filing. So if payments are made by Vietnamese corporate customer to a foreign supplier, that Vietnamese corporate customer are obligated to withhold, declare, and pay tax on behalf of the offshore supplier. This is the same as the existing withholding tax mechanism that is currently operate in Vietnam. And the second is if payments are made by a Vietnamese individual to offshore supplier. The offshore supplier in this case could directly or authorize a Vietnamese party to register and declare and pay tax through the portal launched by the Central Tax Department. And in case the offshore supplier do not register directly with the Central Tax Department, the tax authority would issue a notice to the intermediary party, for example, commercial bank or the payment service provider, requiring these parties to withhold, declare, and pay tax on behalf of the foreign supplier. In terms of calculation, this is actually a deemed tax rate applicable on a gross revenue earned by the foreign supplier. And as you can see on the right-hand side of the slide, that is the table showing the tax rate applicable to the type of commodity and service that are provided to a Vietnamese customer. So in general, service are taxed at 5% corporate income tax and 5% VAT. And the last point I like to highlight is the similar to OECD, the way for tax authority in Vietnam to determine taxable revenue would be the payment information, residential information, or asset information, meaning that they can obtain the BIN number of the credit card, or they based on the delivery address and also the IB address to determine to determine the revenue for tax purposes. And In the next slide, what we will discuss is the how a circle of tax filing for a offshore supplier will look like in Vietnam. So first of all, to facilitate the, can we move to the next slide, please? So to facilitate the the offshore supplier would need to register and obtain a tax account and a tax code through the portal. Once the registration is complete, offshore supplier would use the tax code and tax account that obtained from the portal to declare tax. Of note, the offshore supplier are required to use an authentication code provided by the tax authority in order to receive a acknowledgement receipt from the tax authority sent to a registered email to that offshore supplier, along with the acknowledgement receipt from the tax authority. The offshore supplier will also receive a payment instruction through that registered email to proceed with the payment. Can we move to the next slide, please? I'm continue with the tax filing circle for an offshore supplier in Vietnam. So technically, an offshore supplier can entitle to tax treaty relief, which is exempt or reduction for the CIT portion. That means they will only require to pay VAT portion in Vietnam if they are qualified for the condition to apply for tax treaty relief, including the permanent establishment assessment. And in the next slide, I will discuss some of the current practice in Vietnam related to the digital service tax. So since the first introduction, there have been various unclear tax matters relating to new tax filing mechanism under the Circular 80, causing defer in willingness of offshore supplier to register, declare, and pay tax through the portal. On the left-hand side, we list out a couple of typical issues that are raised under the implementation of the new rule. I won't discuss all of them, but let's focus on the very first concern here, which is whether the existing withholding tax will be removed. At the very early stage, when developing the Circular 80, there has been a question on the interaction between the new DST rule and the existing withholding tax mechanism. However, the Circular 80, when released, did not address these concerns. Currently, there are various double collection on VAT on B2B transaction, especially where offshore supplier apply direct tax payment under DST rule. They already declared and pay VAT. On the other hand, the Vietnamese customer who are under the existing withholding tax mechanism at the moment will also withhold and declare that same VAT to the government. So this has raised a concern to the business community in Vietnam, and we understand that the Central Tax Department acknowledged that there should be further guidance, but said that they still studying the problem. And in our observation, there are not many indications that the Central Tax Department would settle this issue early, despite the pressure from the relevant business community in Vietnam for such development. Moving on to the second point in this slide is one of the questions I've been asked every day since the new DST rule is released, that how many companies has actually registered for and pay tax under the portal in Vietnam. Well, the Central Tax Department has announced in a recent tax workshop they held on 29th of July this year is that there has been various increasing direct registration with significant direct tax payment under the DST rule from 28 foreign suppliers in the 3 months. So we have to acknowledge that the official launch of the portal for registration is in March 2022. Thus, it's only in 3 months they have 28 suppliers already registered for the tax declaration and payment. So in the right hand side of this slide, I like to summarize a few actions taken by the government and also from the high profile foreign supplier that having business in Vietnam. So one thing we know is the government will continue complete legal basis. They also ongoing discussion with relevant government agency, for example, the Ministry of Information and Communication, Ministry of Trade and Industry, and also with the State Bank of Vietnam in how to strengthen the implementation of these tax management, and as well as how to strengthen the e-commerce and digital business and other thing they could do also to modernize the tax management system, educate and support taxpayer at the moment, building their own database as well as preparing for conducting tax audit. And from the taxpayer perspective, we understand that some of high-profile tax company has met with the Vietnamese tax authority to discuss on the compliance of the new DST rule. And also one of them was request their Vietnamese customer who is individual to pay additional 5% June 2022 in the efforts of compliance with the new DST rule. And this will bring us to the final thought on Vietnamese DST rule. In this slide, I have 3 points for you to consider along with a few recommendations. The first thing we need to acknowledge that the unique of the Vietnamese withholding tax regime here is that no revenue threshold and no limitation for service in scope. This means that unlike other international DST practice, Vietnam DST would have broad scope of application, and it's not only taxing digital service but also other kind of service. The next point is the Vietnamese tax authority current approach is to encourage offshore supplier to comply with the new rule, while more aggressive action to ensure compliance would likely come later. Therefore, this is still room for offshore supplier to deliberately comply with the new rule without being penalized for non-compliance. In short term, however, there is no certainty as to how long such comfortable position would last for. The last point on the thought I have today is we should be mindful that though there is no time frame given, the authority are likely to shift from an encouragement approach to an audit approach. And so there might not be a lot of opportunity to get comfortable with the position taken at the moment. So with that in mind, I like to recommend all of you, those who have business or digital service provided to a customer in Vietnam, we must continue monitor the development of such development and implementation of the DST rule in Vietnam. And if in case your business is complex, it is encouraged and recommended that you need to proactively approach the tax authority in Vietnam to discuss how they view on your business model, whether that kind of business subject to the DST rule in Vietnam or not. And lastly, in case we need to clarify on the tax treaty benefit, we can approach the tax authority to understand their view, and if necessary, lodge a official request in writing for a official guidance from the tax authority in Vietnam. And that's all for me today for Vietnam DST rule. Thank you.
Thank you, Anne. Appreciate your running through the topic there. So. A different approach to how to tax these services, and maybe aligned particularly with the way that Vietnam sees foreign contractor withholding tax and so on. So some thoughts for all of us on the call to consider how we manage Vietnam exposure. Okay, now let's take a look at Singapore and see what Singapore's been doing. And I guess, coming back to Sen's point right at the beginning of the session around OECD, then Singapore, although not a member of OECD, has been paying quite close attention to what the OECD has been talking about, and changing its rules accordingly. So first of all, then in January 2020, Singapore introduced its version of digital services taxes or electronic supply of services rules in what it calls the overseas vendor registration regime. And that is applicable at the moment anyway to overseas suppliers of digital services supplied in a business to consumer flow. So business to consumer suppliers who are outside Singapore, not established and not belonging in Singapore, who supply those services globally of more than $1 million a year and within Singapore to $100,000 a year, would be caught by the rules and would be required to register for GST under the simplified, pay and remit model that those of us who are aware of ESS rules would recognize, right? So that's the standard approach to how you deal with the GST compliance. You register, you collect from your non-GST registered customer, and you remit. There is no right to deduct any input tax. It's a pay-only method. Interesting in Singapore that we went for a kind of a bifurcated GST registration calculation. So our standard GST registration rule in Singapore is $1 million per year of turnover. In a digital services world, then we have to look at two different types of flow: $1 million globally, and then $100,000 a year locally. When IRAS introduced the rule, then IRAS was clear that what they were trying to do was level the playing field between overseas suppliers of such services and domestic suppliers in Singapore, and that was their kind of primary objective. It's not really about revenue generation, or it's never really been for them a story about revenue generation. It's been more a story about making sure that there is a lack of incentive from non-GST registered customers to deliberately shop offshore as opposed to onshore. The rules apply also to online marketplaces or platforms, and in a situation where the overseas vendor is selling through a platform, or an online marketplace, then the rule would default through to the marketplace, assuming that the marketplace is clear that they are facilitating the supply, that they are responsible for collecting the payment, and a few other tests as well. That would mean that the online marketplace needs to register, charge, and collect, and that keeps the overseas vendor in that situation we're supplying through a marketplace. That keeps them out of the regime and out of the net. So one of the points that you would need to think about if you are indeed an overseas vendor and you're supplying digital services is to understand the contractual relationship you've got with your marketplace, and make sure that you are not also charging and collecting, and the marketplace is also charging and collecting. That's obviously then we've got double GST. The rule overlaps with our GST reverse charge regime in Singapore, such that an overseas supplier needs to obtain a GST registration number from its customer, and there are certain customers who might be business customers but are not GST registered. Those customers also need to assess whether in fact they've got a B2B reverse charge obligation as a result of the service that they are receiving. So that also needs to be taken into account. And indeed, where a business is GST registered but not able to recover all of its tax, and therefore it can provide a GST registration number to the overseas supplier, then although the overseas supplier would not need to charge GST, the recipient business would still need to self-assess and account under our reverse charge regime, which came in at the same time, also in 2020. So there are a few kind of nuances and layers to our overseas vendor ESS rules, and those are all need to be taken into account as you're looking at what the process is. If we move to the next slide, then we can take a little bit of time and walk through the digital services definition. So what does IRAS think is a digital service, and therefore how should it be addressed? So IRAS did go to the time and effort of defining what a digital service is. It is a service, as you can see here, which is supplied over the internet or an electronic network the nature of which renders the supply essentially automated with minimal or no human intervention, and a supply that would be impossible without the use of IT, information technology. More relatable, I guess, is if we kind of get down into the examples of the services. So examples of services would be things like downloading digital content, subscription-based media, like signing up for the digital newsletters or digital magazines, or streaming. So Netflixes and Disney Plus and so on. Those would all be digital services under the definition. Online gaming, of course. Software programs, so downloading of software or downloading of other kind of software programming, website filters and firewalls and so on. Electronic data management, so website hosting, online data warehousing, cloud storage, and support services, which might not necessarily be digital in nature, but are performed via electronic means to arrange or facilitate a transaction. So commissions or listing fees or service charges, which are performed via electronic means to arrange or facilitate a transaction, which might not necessarily be digital. So those are the key kind of digital services definitions as IRS has set them out. Interestingly, what was explicitly excluded from digital services were professional services which involve human intervention, even if that is provided by electronic means, like legal services. Other things were explicitly excluded, like telecommunication services, because they were taxed via a different mechanism and wouldn't need to be caught. So from 2020 until now, then we've had a digital services rule which is quite explicit around electronic supply of services, and it's pretty traditional, right, in how it applies to digital content and the impact on overseas providers. If we move to the next slide. Thank you. So taking into account what Sen said at the beginning around the OECD and what the OECD's recommendations were on how best to tax the e-commerce world, then IRAS in their most recent budget announced an extension to the digital services rules. So from January 2023, what we're going to have is in fact a remote services rule, which is much wider than the digital services rules that we are familiar with for the last couple of years. So in addition to the digital services, we're going to extend it to overseas suppliers of remote services in a B2C context. Remote services are defined by the Revenue Authority as being services where there is no necessary connection between the physical location of the supplier and the place of physical performance. Sorry, the physical location of the recipient and the place of physical performance. If you think about how to kind of unravel that, then IRAS gives a couple of pretty good examples. So if you imagine a hairdresser, and you're going to get your haircut, there is a necessary connection between the physical location of the recipient and the place where performance takes place, because obviously you've got to be pretty close to the scissors to experience the haircut. But in a remote services context, then we can provide a digital service, and you don't need to be physically located. So an example might be a fitness instructor who might be in a wonderful location on the top of a cliff in South Australia, doing some yoga, and we all sign up, not me personally, but we all sign up and enjoy the class. There is no necessary connection, right, between the physical location and the place of performance, and therefore that would be defined as a remote service. Things like fitness courses, things like telemedicine, things like educational courses, particularly live educational courses, would fall under this rule. Also, what falls under this rule are things like professional services, financial advisory services, services provided by accountants, by lawyers, when they're supplied from outside Singapore to a non-GST registered recipient. So the test for the overseas provider in one of these situations is who are you providing your service to. So if the recipient of the service is not able to provide a GST registration number, and you are able to provide that service remotely, so no necessary connection between the place of performance of the service and the physical location of the person getting the service, then what you're providing is a remote service. And then you need to go back to the registration rules and look at the registration rules in a bit more detail. If you are providing $1 million globally, Sing dollars globally, of such services or any services, and $100,000 of those services into Singapore to non-GST registered recipients, or recipients who can't give you a GST registration number, then you trigger your GST registration obligation. That means that you would then need to register, charge, collect, and remit the GST on those fees that the local customer is paying to you. And your GST registration comes with no right to deduct any input tax on the other side of it. The remote services rule will also be relevant for B2B services as well. So although in these contexts, then the recipient might be able to provide a GST registration number, they still need to consider the impact of reverse charge on these services, and so they would need to also take into account and track and capture these services as they are buying them from overseas recipients. So we moved from a very defined digital services tax rule in the kind of traditional let's take into account Netflix and other kind of digital streaming type services, and apply our ESS rules to those, to a much wider definition, which brings into Singapore GST net not only our traditional digital services providers, but also other providers, telemedicine, fitness instructors, but particularly in the context of other sorts of things that we see every day, then accounting, financial advisory, and legal profession, where they're providing those services to non-GST registered recipients, would also need to take into account the value of the services they're providing and track and charge and collect. So a much wider range of services and a much wider implication for non-established service providers. Move to the next slide. Okay, so that wasn't all that was introduced in that budget. So in addition to extending out the digital services rules to remote services, Singapore government took the opportunity also to look into the low value goods rules. And as Sam was explaining also at the start, then the low value goods rule in Singapore has been a reasonably generous one for the longest time. And the last time I looked at the thresholds, then Singapore's was I think perhaps the third highest in Asia Pacific. Most of the countries in the region had already reduced their low value goods threshold down to a very low threshold indeed, and sometimes some countries gone away completely. Australia had a fairly high one, about $1,000, but I think it's gone. New Zealand's was similar to Singapore, but has also gone. So Singapore is one of the last ones to kind of look at this in any detail and do something about it. So the rule used to state that where you import goods and the goods have a landed value of less than $400 or $400 and less, that they could come into Singapore via air or post at least without any GST on them, without any import GST. And from an e-commerce perspective, then that's jolly beneficial, right? Because you can buy quite a lot of clothes and shoes and equipment and so on, right, for less than $400 and get it imported into Singapore and no GST on it. And obviously, that is a disincentive to Singapore GST registered suppliers, because in the bricks and mortar world, then they're paying GST and incurring lots of costs, and that's not so helpful. So Singapore government took the opportunity to align both the remote services rule and a new low value goods rule together. So with effect from Jan 2023, then we're going to remove the low value goods incentive, so that where goods are imported via air or post with a value of less than $400, then that those goods will be subject to import GST, or rather will be subject to GST, which will be charged and collected by the overseas vendor. It aligns with the OVR rules, and therefore the consumer is going to have to pay the overseas supplier, and the overseas supplier is going to have to think about the registration threshold, $1 million or $100,000 of local sales. Interestingly, then, for businesses who are not able to recover all or part of the GST that they incur, so particularly financial services businesses, but also charitable businesses or educational establishments, then they also need to track any goods that they're going to buy that fall under the $400 threshold and are bought from somebody overseas, because they're going to have to apply reverse charge on them. So the low value goods rule adds a bit of complexity into the partly exempt businesses, because they're going to need to track something that they've never looked at before, and make sure that they are able to demonstrate that they have appropriate controls in place to charge and collect. If the goods are sold by an overseas vendor through a marketplace, then you can default to the marketplace and let the marketplace be responsible for charging and collecting, subject to a few conditions. In particular, that it's clear that the marketplace is going to be responsible for billing the customer, and has a GST registration number, of its own. And that's probably an incentive for a number of vendors outside Singapore who are selling goods to actually look at platforms and utilize the platform, rather than having to maintain a GST registration, particularly or specifically for Singapore. I mentioned the reverse charge. That is something that is kind of a new obligation on businesses who are subject to reverse charge. So that falls as part of the change in the rules as well. So all of this takes place from January 2023, and kind of reflects the OECD's model around making sure that there is minimal leakage from overseas suppliers, both in terms of the services that they supply into Singapore, whether they're digital or not, but particularly where they are remote, and also in terms of goods, whether they are more than $400 or less than $400. So with that, then maybe I'll turn over to Sen and ask Sen what's going on with Malaysia.
Thanks, Richard. Pretty much after Singapore sort of announced that they were going to do low value goods, of course, Malaysia decided they were going to follow suit. So there was an announcement in the October sort of budget for FY23, so that was announced last year, that they would look to expand the scope of the sales tax to impose sales tax on foreign sellers who sell low value goods, and then proposed a date of 1 January 2023. Now, up until August, there was nothing else that was made publicly available other than the statements in the budget. What we understand during that period, the authorities had a number of consultation sessions, or one-on-one sessions with some of the participants in the industry. What we saw earlier this month, though, is the first sort of sign of some legislation. So a bill was introduced before the lower house, and it is now passed. It's now waiting to be tabled before the upper house, and then assuming that it's passed, then it would have to go to the King for royal assent. The bill itself, and I'll touch on some of the information that's come through from that, doesn't have a lot of details yet. A lot of the detailed information will be in the regulations, the orders, and the guidelines that would only be released after the date of royal assent. So for the moment, it's unclear whether that 1 January 2023 date remains the commencement date, or whether that's likely to be pushed back further. I'll give some thoughts later on what that possibility might be. So if we go to the next slide, so what do we actually know so far? So in terms of definitions, a low value goods is going to cover any sale of goods from outside of Malaysia into Malaysia. The goods in question must have a value below 500 ringgit. So 500 ringgit is the current low value threshold, and that applies to any goods that are supplied by through air courier. So under the existing regime, any goods that are delivered via land or sea are taxed regardless of the value. An interesting item there is that the goods will still be in scope whether they're currently taxable or non-taxable under the sales tax rule. So it means that if it's a low value good, even if it's an exempt good under sales tax, it can still be taxed. Another interesting distinction that is different from, say, Singapore and the OECD is that there is going to be no distinction between B2B and B2C. This is consistent with the earlier remote or digital services rules that were implemented in Malaysia as well, where there was no distinction. And it's largely because the Malaysian sales tax and Malaysian service tax is not a VAT or a GST system and doesn't follow those principles. If we look at the definition of a seller can include both local and foreign sellers. So a local seller can still be caught where there's a sale where the goods originate from outside of Malaysia and then are delivered directly to the customer. It also includes in the scope platforms that facilitate the sale. So similar to Singapore, if a sale is made through a platform, we envisage that it's going to be the platform that will be held responsible for collecting the tax. Now, as I mentioned, the existing rules only apply to shipments via air, but under the new sort of proposed LVG rules, low value goods principle would apply to all forms of transport into Malaysia, sea, air, or land. If we move on to the next slide, the applicable rate that we're going to look at is 10%. So that's currently the standard rate for sales tax for domestic manufacturing and for domestic imports. There is a 5% rate and an exempt rate. For low value goods, that the 5 or the exempt will not apply, so everything will be subject to 10%. And sort of another area where Malaysia is a bit out of step with everyone else is the value on which the tax will be calculated will actually be the actual sales price for the goods. It will not include costs such as insurance and transportation. So, whilst that is potentially a lower cost for the consumer, it's not consistent, and it means that it's another headache for sellers or platforms because they have to outline a different methodology for Malaysia to calculate tax compared to, say, Singapore and other countries. The revenue threshold for Malaysia will be 500,000 ringgit. That's about $120,000 give or take, to register. And then once they're registered, they'd have to file a quarterly return. Again, no details yet on return format or on how registration will be, or even invoicing requirements. We're hopeful that it will sort of follow suit with what we saw with the service tax, where we saw very simplified registration, very easy filing online, and the ability to use foreign bank accounts. But we just have to wait and see for more information there. So what are the key challenges? And we move to the next slide. So for foreign e-commerce providers and sellers, that Malaysia's got a very unique challenge in that it's the only country in AP without a VAT or a GST system that is trying to implement these frameworks or trying to be in step with what the OECD is doing. It's previously adopted the remote services, electronic services rules under its service tax, which, as I mentioned, apply to both B2B and B2C. The expansion of the sales tax of low value goods is going to be an even bigger challenge because effectively with the sales tax, what you have is it's a wholesale tax. It traditionally applies to manufacturers and importers. Now, what's happening here is we're trying to take this wholesale sales tax and make it like a VAT, in that it's going to now be applied to sellers of low value goods in a way similar to that on the retail sales price. And it's also going to apply again to B2B and B2C. And also, there's an additional hurdle there where if you are a service provider, whether that's a platform or a foreign seller who provides both electronic services or remote services and also sells low value goods, for Malaysia, you're going to have 2 registrations and the need to collect 2 separate taxes at 2 different rates. So that's 2 filing requirements. And so from a systems perspective, that poses a very significant challenge. So in considering all of these challenges and the uniqueness of the Malaysian model, an implementation timeframe of 4 to 5 months is extremely challenging, especially with the little that we know so far about how it's going to work. We still expect there's going to be a lot of changes, between now and the go live date. So hopefully there'll be a delay. There may be a delay, but I don't expect there to be a significant postponement of the tax. So I think from business's perspective, you've got to really plan for the worst case scenario and then hope for some leeway from the government. Okay, back to you, Richard.
Thank you, Sen. I appreciate you running that through. And as always with Malaysia, then a little bit of wait and see. Okay, we have about 5 minutes left to go, and we have time for some questions and answers. We have had some questions in, but maybe let me just reflect on what Sen was just saying and ask a question back to Sen. So Sen, we're talking about a rule introduced in January, specifically on sales tax. There has been unceasing rumours around GST. And what might happen if, the fact that Malaysian government would like to bring back a GST. What do you think would be the implication, if a GST is brought in? Do you think that digital services rules will follow, and do we think that low value goods rules would stay and follow the same kind of structure as we've just seen outlined here?
My expectation is that they would simply adapt or bring in some of these requirements into the GST. So I think prior to the abolition of the GST, they were already looking at expanding the scope to bring in electronic services. So I don't see that if we were to go back to a GST that we would see a removal of these requirements. It would simply just be added onto the GST.
And thanks, Sen. And any latest news on timelines for potential introduction for GST?
I don't expect any announcements in the upcoming budget. I suspect that the government will wait a little while until at least the the inflation issues are resolved. I'm not expecting something in the next sort of 6 months at least. No announcements.
Okay, thanks, Sen. So we can rest easy for a little bit longer. Okay, Anne, maybe a question to you. So we heard about the Vietnam digital services tax regime seems to be wider than just indirect tax. What's your impression of how strictly or how aggressively the Vietnam tax authorities have been enforcing the rules and pursuing registrants?
Thanks, Richard. Well, if we're looking at the implementation of the Circular 80, which is the guidance for the DST rule in Vietnam, the first question would be whether the registration on the portal for offshore suppliers is a mandatory requirement from the government, or the offshore supplier have the option to directly register or authorize to other party to do so. On the wording of the circular, I would say it seems they have the option, but in practice, what we observe is we can say that the local tax authority show a strong intention to request the foreign supplier to directly register and pay tax through the portal. So having said that, we also acknowledge widely in Vietnam that the existing withholding tax regime is not effective to collect tax from B2C transaction. So why right now there is no strong enforcement payment directly, we could see that it's very short term. The government will shift from the encourage approach to a more enforcement approach, where they request that those that having B2C transaction with Vietnamese customer will have to do so to comply.
Okay, thanks, Anne. So in summary then, the tax authorities have been nice so far, but don't count on them being nice for the future.
Yeah.
Thanks. All right, so I think we've got time for one last question, and I'm going to take this. It's about Singapore. So the question is, how do the new low-value goods rules in Singapore interact with the existing import GST rules for sales of goods with a value of more than $400? So a point on on value. So in Singapore, then for the low-value goods rules, we also go on sales value, excluding the transport costs and so on. So just to clarify what the $400 is all about, the two rules are complementary, I guess. If you are importing goods more than $400, then that follows our standard import GST process, which means that somebody has to make a declaration and report those goods and charge and collect GST at that point of importation. Whereas for goods below $400, then there is no import declaration. There is simply a requirement that the seller, whether that's an overseas vendor or a platform, charges and collects and remits the GST on the value of those goods. There is no import declaration. The goods come through by air or post in the way they always have done. So there are kind of two steps, right? So sales value less than $400, charge collect if you're overseas, and it falls under the low value goods rule regime, and then it's remitted via the GST return. For imports over $400, then it's an import declaration, and the GST is reported and paid prior to importation at the point the goods are cleared, and then the import GST is claimed back, assuming that the importer is GST registered. If the importer is a private individual, then it's a cost to that private individual. So that's how it works. I hope that clarifies the question. Okay, we are out of time, so I need to wrap up the session. Sen, Anne, thank you, and special thanks to all of you. We'd like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think of today's program. If you joined us late, please note the presentation will be archived for future viewing. If you feel that others would benefit from the webcast, please share it via the share this icon, or have them visit the Debriefs website. We'll respond to all the questions that were submitted during the webcast in a couple of weeks if we haven't managed to answer them today. Also, if you think of any other questions or comments, please feel free to reach out to me or either of our two other speakers, and we'll be very happy to talk to you. Please don't forget to tune in to our next scheduled webcast, which is coming from the Corporate Income Tax series on the 16th of August, titled Taxation of Cryptocurrency in Asia Pacific, Current and Proposed Tax Regimes. And last, from all of us at Deloitte, thank you for participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.